Spotify is the market leader in music streaming, and it has changed the industry forever.
Yeah, so no more getting mysterious viruses from LimeWire.
But despite making over 13 billion euros in revenue in 2023, the company is still losing money. So what's wrong with Spotify, and do you really know how to make money?
Yeah, so in this video, we'll cover how Spotify started, its business model, recent highlights and feature releases, and future developments to keep an eye on.
And we'll even cover how the competition in the music streaming industry stacks up, so stick around.
I'm Stephanie, tech veteran, engineer, and creator.
And I'm Bertrand, founder of App Economy Insights. Spotify was founded in Sweden in 2006 by Daniel Ek and Martin Lorentzen, and it's become the largest music platform in the world. The company has transformed the music industry by moving from a transaction-based experience of buying and owning music to an access-based model of streaming music on demand. Now, they are investing in podcasts and other audio content to complement the music library and become a media and discovery platform.
They make money through a freemium model. Premium subscribers, paying users, get ad-free, high-quality music for a monthly fee, around $9.99. There's also a free ad-supported tier with limited features. They make money based on the number of users on their platform. Monthly active users, MAUs, include premium users and ad-supported users.
So if we turn to financials, revenue has two main components. Premium revenue makes up 87% of overall revenue. Spotify sells its premium service directly to end users and through partners that bundle the subscription with their own services. It has many plans from standard, family, duo, student, you name it. Next, we have the ad-supported services, and they make up 13% of overall revenue. It serves as a funnel to premium. Advertising arrangements are sold on a cost per thousand basis, the number of ad impressions. Podcast monetization is an important initiative for this segment. It monetizes through the Spotify Audience Network, or SPAN for short. It's an audio advertising marketplace.
Something that should jump at you in this visual is Spotify's huge cost of revenue. It's primarily royalty and distribution costs related to audio content. Royalty paid to record labels and music publishers is roughly 70% of revenue. And this goes to Universal Music Group, Sony Music Entertainment, Warner Music Group, Merlin, which includes digital rights to hundreds of independent record labels, and other smaller labels. And in addition, cost of revenue includes amortization of podcast content assets over time when they are released, similar to Netflix, credit card payment and processing fees, customer service, and other costs like hosting and equipment.
Okay, if we look at operating expenses, there are primarily sales and marketing, which makes up 12% of revenue, and it includes brand marketing, but also customer acquisition cost. Next, we have research and development, which is 13% of revenue. Spotify invests in product design and features to improve user engagement, retention, and conversion to premium. And finally, we have the general and administrative expenses, but it's less than 5% of revenue.
Now, the gross margin is very low, slightly above 25%, primarily because of the royalties paid to record labels and music publishers. Again, roughly 70% of revenue. Spotify doesn't own the majority of the content on its platform and gives away most of the revenue to content providers. Operating margin has been break even to slightly negative since the 2018 IPO. In short, the gross profit is too thin to cover all operating expenses. So all in all, Spotify has a very low gross margin profile and a revenue highly dependent on a content library that belongs to a select few labels and publishers with huge bargaining power.
Before we talk about how Spotify's massive investment in podcasts is working out, yes, we are going to ask, please smash that subscribe button.
Yeah, it might not seem like a lot, but it does help our videos be discovered. And it's how we keep bringing you more tech, investing, and business content. We've all heard about the Spotify massive deal with Joe Rogan, reportedly worth up to $250 million for his podcast. But this signing reflects a bigger shift in their strategy. While they're still spending big on exclusive content like Rogan, they're also focusing on being more efficient with their resources. Back in 2019, Spotify made a big push into podcasts. They bought studios like Gimlet Media and Anchor FM and signed exclusive deals with celebrities. It was an exciting time, yes, but it wasn't really sustainable and it led to layoffs. I found it funny also that it's on Gimlet Media's site that I found out Spotify's media acquisitions weren't really going that well. And of course, it's a podcast that's streaming on Spotify. Following a period of aggressive acquisitions, Spotify is now shifting gears, prioritizing efficiency and concentrating on high-performing content.
And it looks like it might be working. In Q4 FY23, they hit user growth targets, adding 28 million monthly active users to 602 million total, and 10 million premium users to 236 million, both exceeding expectations. Revenue grew 16% year-over-year to 3.7 billion euros, with premium revenue up 17% year-over-year. This growth is driven by an increase in subscribers and higher average revenue per user, or ARPU. They are successfully converting free users to premium and raising prices slightly. North America and Europe are critical to Spotify, making up nearly 2/3 of the premium users. Even the ad-supported tier hit an all-time high. Music and podcast advertising both grew in the double digits.
Operating expenses increased 6% year-over-year in constant currency, a slower pace than revenue, thanks to reductions in marketing and personnel costs. There were 143 million euro one-time charges related to efficiency efforts. So, excluding those, Spotify was profitable on an adjusted basis. The operating margin has been break-even to slightly negative since the 2018 direct listing. The gross profit is too thin to cover all operating expenses.
And this chart speaks volumes. Despite tripling its revenue since the 2018 direct listing, Spotify has failed to expand its margins, effectively only breaking even. This means they are generating just enough money to cover all their expenses. Despite strong user and revenue growth, Spotify hasn't translated that into consistent profits. The company has become unprofitable due to aggressive investment in content, but it might change after this latest round of layoffs and restructuring.
Spotify generated nearly 700 million euros in free cash flow in 2023 and has a strong balance sheet with over 4 billion euros in cash. They generated 396 million euros in free cash flow for Q4 alone, thanks to better working capital management and higher adjusted net income.
Now, they continue to build an audio network. They expanded the Spotify Audience Network into 5 new markets, including India, Japan, Brazil, Mexico, and Sweden. They launched new podcasts like What Now with Trevor Noah. They launched their first in-app merch hub, which provides personalized merchandise recommendations based on user listening habits. In November 2023, they made over 200,000 audiobooks available to eligible premium users in the US with up to 15 hours of audiobook access per month. Management says that data shows that their entry into this market has dramatically accelerated its overall growth. In Q4, they became the number 2 provider of audiobooks behind Audible. It might be a small market though. These are all good baby steps, but so far, Spotify has failed to improve revenue for artists directly on the platform. Think of models like Patreon offering a direct relationship with fans. It seems like a big missed opportunity to improve the ARPU.
AI-generated music is a double-edged sword for Spotify. It's definitely an exciting innovation, but creators worry about copyright infringement. A recent fake song featuring Drake was pulled after 600,000 listens, raising concerns about potential chart domination by AI music. CEO Daniel Ek acknowledges the challenge of striking a balance between innovation and protecting artists.
Advertising offers a path to higher margins, particularly within podcasts and the Spotify marketplace. However, Spotify needs to improve ad targeting. Look, I've been served ads in Spanish on Spotify even though I don't speak the language. This suggests limitations in their data collection and targeting capabilities, potentially hindering future advertising revenue.
But there is a silver lining. Studies show music streaming is one of the last expenses people cut. Unlike video streaming where people chase new releases, Spotify has strong user loyalty. Look, we love our curated playlist. That and offline access create a sticky experience. And this can give Spotify more pricing power than expected.
Apple and Amazon are obvious competitors today, but the real threat might come from somewhere else. Platforms like TikTok, with their focus on short-form video and music discovery, could be major rivals. As Spotify relies more on advertising, they'll need to compete for attention against established players like YouTube. ByteDance quietly launched TikTok Music with a gradual rollout. This, coupled with TikTok's dominance among young music fans, suggests a potential challenge to Spotify's market share.